Good afternoon, my people. Welcome to 15 Minutes of Finance with your main man, Charles Tank Harris, on what will forever be known now as Wild Wednesdays. I can't talk this year. So we have an interesting show for you today. We are going to discuss what we need to do differently with our finances in 2023. I thank each and every one of you for being here with me. The intro and outro for the show is still being edited and worked on. So today you just come right into having me. But moving forward, you're going to see some great video, audio enhancements to the start and end of the show. We are also breaking the show up into 3 segments moving forward. The first segment is where I answer a question that has been emailed into from somebody in the studio audience or just on the internet out there in social media world in general about whether I think they should go or no go with the ideal that they have sent in. And today I have an interesting go or no go topic on debt consolidation that we will get into. After we get out of the go or no go segment, we will move into the heart of today's conversation, which, as I've already hit on, is what we can do differently in 2023 with our finances. And then to close out the show, I will sum up with 3 actionable tips how to do better what we talked about in the heart of the show. So with no further ado, let's get into today's show. Our go or no go question is in regards to consolidating debt when refinancing. A lot of people right now, even though interest rates are rising, are looking at doing refinances of their property, or they're purchasing property, they're taking equity out of homes, they're doing things that are allowing them to look at the outstanding debt that they have, be it credit card debt, be it student loan debt, business debt, auto loans, and they are considering rolling this debt into their new loan. So let's start with explaining at a very understandable level what consolidation actually means and what it looks like. If I have credit card A and credit card B, and total between those 2 credit cards, I owe $5,000. Now I am about to refinance my home. And when I'm refinancing my home was worth $300,000. Now it's worth $400,000. And I want to get access to some of the equity that is in my home. So I call up a mortgage company. I say, hey, I have this mortgage on a property that was worth $300,000. I owe about $270,000 on it. I'd like to refinance my house. I hear it's worth more now. So the people from the bank or the mortgage company will send out an appraiser, and they'll see what your house is actually worth. And if it comes back that it's worth $400,000, in most instances, they will be willing to lend you $320,000, which is 80% of the value of the house. Yes, there are programs that will do more. There are circumstances where you would get less, but we're going to stick with a traditional 80-20 situation. They've appraised your house for $400,000. They're willing to give you $320,000. You should understand that anytime you do any type of refinance or mortgage relationship at all, there are fees involved with that transaction. For the sake of this particular example, we're going to ignore the fees. And we're going to say that you are at the closing table and have the ability to get a check for $320,000. The first thing they're going to want to do, it's forced, it's not a choice, is they're going to pay off the outstanding mortgage that you have. So with that $320,000, we talked about the fact that you owed $240, $260, I think the number I used. Let's use $240. We're going to send the other mortgage company $240,000. That leaves you $80,000. This is one of the main reasons people refinance. They refinance so that they can get use of the equity in their home. So now here you are sitting with $80,000. Sometimes people refinance to fix their kitchen up, sometimes just to have cash. The person who emailed me said they want to refinance to pay off their credit card debt. Now, here's where the go or no go comes in. This new mortgage that this person is signing up for has an interest rate of 6%. They're getting a 6% mortgage interest rate. The person emailed me and said, Tank, my credit cards are charging me 24 and 28% respectively. Isn't paying 6% on debt a lot better than paying 24 and 28%? If that was the only thing that mattered, my answer would be yes, and you should do this. But that's not the only thing that matters. For those of you who have been following Wealth Our Way long enough, you know we talk about not just the cost of debt, but the totality of the debt we have to pay back. If you have $5,000 of credit card debt being charged at a very high interest rate, in this case 24 and 28%, but you pay that debt down aggressively over the next year, 3 years, 5 years, the total amount of interest that you're going to pay is going to be short in the terms of how long it takes you to pay back. It's going to be high in terms of what the cost was over that short period of time. Now we can get a pen and a paper out, or a calculator in this day and age, because nobody likes math anymore, and we can see what would have us paying back more interest over time. Paying back 24 and 28% interest for 3 years, or paying 6% for 30 years. I'm here to tell you without a calculator that 6% on $5,000 spread out over 30 years will cost you far more interest than paying 24 and 28% and getting it paid off in 3 years. So to this particular viewer who sent this question in, and the question, let me revisit the direct question: should I roll my credit cards into my new mortgage? The answer is no go. Do not do that. You need to find a way to pay your credit cards down with monies that is not being paid over 30 years. You are going to, the best plans in people's minds are, they always look most favorably on their situation. They always say, oh, but I'll pay it back in 3 years from my job, but I got my rate down to 6%. They never do that. I would say more often than not, 90% of the time, they don't do that. They just keep paying the mortgage payment until they either finish the mortgage payment, sell the house, or refinance again. So you're not going to say, oh, for 3 years, I'm going to put a little bit more on this mortgage to catch up to my outstanding debt. So consolidating high interest credit cards into a 30-year mortgage is a no-go for this particular situation. Moving into the heart of today's conversation, what are we going to do differently in 2023 with our finances? Every year, when we turn the calendar page, we have two major resolutions, and some people will say three, in our lives: our health, our finances, and that third one could be our love life. But I'm, of course, going to focus on our finances. What do we do differently in 2023 to not be sitting here when we get to December and saying, I'm in the same situation that I was in last year? Well, this perfectly works up to one of the changes we've made with our clients at Wealth Our Way. We're focusing everybody now at Wealth Our Way into our Think Big Financial Freedom course, where BIG is an acronym, B-I-G, baby. And the BIG references budgeting. Who didn't know that was coming? Investments and generational wealth. We cover the blueprint of our finances, the base of our pyramid, getting our budget together. Then we know, because we've budgeted, how much money we have for investments. And then lastly, we make sure that after we've lived off of our funds into retirement, we transfer G to our generational wealth and make sure that our heirs or our philanthropic interests are covered. In 2023, whether you're a client of WOW or following any other type of financial guidance, I want you to think big. I want you to sit down and come up with a budget. I want you to, once you've made your budget, focus on how much money you can put aside for you. Pay yourself first, how much you can invest. There are many tools. You can also email us here at info@Wealth Our Way to determine how much money you're going to need in retirement. And that will help you understand how much money you need to put away, how much you need to earn on the money you're putting away, and what you'll be able to yield off of those monies in retirement. This is also something we cover in our Wild Wealth Jumpstart course with our Wild Wealth Jumpstart program, when we help people do a life insurance assessment and retirement planning assessment. Retirement planning is not as mystical and multi-stepped as people make it out to be. It's very simple if you really focus upon it. It's making sure that you have enough money to put away. One of the biggest things I see is investment, what's the word I want to use? Investment regret. When you commit to putting a certain amount of money away, but you overstepped your budget. You had great intentions, but you put too much money away, and now you can't handle your day-to-day life obligations. That's not cool. You want to make sure that you're budgeting and you come up with a category for savings and investment, that you're directing those funds into an investment, that you're comfortable with the amount of risk you're taking, and then an advisor like myself or others can tell you what that amount of money will yield. With that, that's what we're going to do differently on this program. For all of you watching, I'm going to encourage you throughout the programming, whether it's on 15 Minutes of Finance or the Financial Power Hour, to think big in 2023. So here are 3 actionable tips that you can do today. You can go to, shameless plug for my homie from the Life 101 platform, Brandon Copeland. You can go to Etsy or life101.io, I believe it is, and download their budgeting tool. I think it's $4 and change. It's a great tool that all of the Wealth Our Way clients are getting for free this year. It's my gift to them to really map out your budget and let you know where your dollars are. The second thing that we have to do, the second actionable tip, is to take best use of a dollar. Best use of a dollar will tell you to max out your company retirement plan up to the match, and then to switch over to a Roth IRA. And then after that, to look at your outstanding credit card debt or go back to your employer's plan to use the rest of the money that you have budgeted for your retirement saving. So get your budget game tight, practice best use of a dollar. The last actionable tip is stay tuned in to Wealth Our Way Network content in 2023. I promise you that this program is going to do more for you this year than it's done in years past, which is saying a lot because we've always blessed everyone who has listened to our content. With that being said, I want to send a housekeeping note. We are behind on paying off our debts. Tashawana, you won the contest that we ran in December, and your person that you nominated will be receiving the $250 that we promised. That is going to get handled before the end of the month of January because we always pay our bills here at Wealth Our Way. And I want to thank you, Tashawana, for your continued support of our programs and continued support of our contests. I want to thank each and every one of you for starting off the new year with us. Please stay tuned. Like I said, I have a heavy lift going on in my life personally with this company as well as another company I'm involved in. So I'm working harder than ever before, but providing quality content on Wealth Our Way Network is what I am about. And I promise you, you are going to see a lot of changes moving forward. So please remember, moving forward, as always, wealth is not only for the wealthy. I'll see you soon.